Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets, which he says were up, and up. He points out gold seems to be taking a break and that uranium has had a really positive run. Veteran trader Victor Adair chats with us from Vancouver Island. He talks about how to trade in such a volatile market and discusses what kind of energy policies we might see from Canada's newly minted Prime Minister. Do we trade our oil and gas or keep it in the ground? He also points out two stock markets that are outperforming the American trading desks. Publisher of the Leibovit VR newsletters, Mark Leibovit, weighs in on the effect of a full moon this time of year, Bitcoin, Tesla, and the possibility of Alberta splitting from Canada. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, talks about the state of real estate in the U.S., mortgage rates, and what he believes is the real driver of American inflation. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure to be with you, Jim.
How would you describe what happened on the stock markets this week?
Well, it was up, and up. So you've got 5 days in a row with the S&P making new highs for the move. And, if we look at it, you look at 50% corrections or 61.8% corrective rallies as far as Fibonacci levels as being those of major consideration. And as of 2 weeks ago, most of these indices had retraced 61%, which is where you would expect that if the downtrend was going to continue from what we had seen from the February highs, then we should have been looking for the market to roll over at that point. Well, it only spent about 5 or 6 days at that level, and then as of Monday of this week, it's popped through that resistance level. So of the two models that we've got, one that will look for a roll in here and then back down to retest the low fairly quickly. That one has been violated, and when you look at the longer-term trend, the support was found at the long-term moving averages when we look at our monthly and quarterly charts. So this push to new highs for the move as of actually each day this week would present us with the option of the most probable outcome being small corrections and then reaching into new highs before the next deeper correction. So, the market's got steam right here. And if we look at the global M2, that would be the money supply from all the major countries. We see that that has continued higher and higher for the last few months. It has a forward projection to it when we look at it that money is always looking for a new home, and it tends to take time to find that level. So if we look at the M2, it basically forecast a low for April with an upside action as we move forward into September. It could be that this thing is going to have some strength longer than we thought at this point. So we'll watch for key support levels as we stair-step our way up and see what the next few months has to offer.
What's going on with gold?
Well, gold peaked right where it should have with the bottom in the U.S. dollar. The dollar index had one of those capitulation levels that we see very infrequently, and the dollar back, exactly on the same day that the gold market top was the bottom of the U.S. dollar, and we're going to be looking for this gold market to ease back down. It's now come to the 50-day moving average, which was our first and our minimum target on the downside. We've had 3 days down here, so we're down from 3,900 down to 3,190. We've got some oversold signals in the last couple of days, so we could easily get maybe a 38 to 50% retracement rally. But the best thing to be looking for, ideally, will be a drop to the 200-day moving average. That's quite a bit below us at this point. And the other thing we would look for when we've had such a move in the U.S. dollar and its reversal is that the gold market will give up ground until the relative strength index, that's the RSI 14, until that gets a level below 35. And that could take days or weeks, but I think one's going to need patience at this point as far as the gold is concerned. Same type of thing in silver. We're in a consolidation phase here, and we put in what we believe to have been the 5-year low here just a few weeks ago. No sign of a breakout, but that's one that we want to be watching pretty closely over the next month or two. If we were to get a breakout in silver, and we'll be looking at the quarterly and monthly RSIs there, if we were to get a solid breakout, then we could easily be running until next April. That would be part of a 5-year cycle that is due to top out as we move into the second quarter of 2026.
What's going on with crude?
Crude, we had a capitulation low down on May the 5th. I didn't think we'd get much out of it, but the crude oil has managed to rally from 55 up to resistance. If we take a look, the old support from March and from September was at 64. We've got back there and kissed that. Also, if we look at it, we've kissed the 50-day moving average, which is a reasonable resistance level. I think we should settle back a bit from here. Don't see too much on the upside in terms of major potential, but it's been a decent rally for those who got on board, and sorry we weren't there. What's
happening with the U.S. and Canadian dollars?
Well, the U.S. dollar, as I say, got some pretty major extremes here, and it has now rallied back to the 50-day moving average, which is just a natural spot to see some resistance at this point. So it was a nice trade off the bottom. I think it's had the bulk of the move for now. We'll look for a period of consolidation at this higher level now, but I think that the bulk of that move has come and gone. On the Canadian dollar, the commitment of traders has now entered into a level that has a commitment of traders sell signal, that being that the speculators who were just super long months ago, and wrongly so, ended up bottoming and much later, and I think caught a lot of them off guard. We now have the other side of the coin where the speculators have found themselves net long, and this market looks pretty vulnerable. We did have sequential signals a couple of weeks ago indicating that we should be looking for a rolling top. And, we've seen just that. This market topped out about 2 weeks ago, put in a little false breakout a week and a half ago that has had no upside, and it's starting to gain a bit of downside momentum right now. So I think the dollar can, drop down to the 71, maybe 70.5 level on the Canadian.
Anything else we should be keeping a close eye on right now?
Well, we had a good call on the uranium's capitulation lows, and we've seen just a significant move now since that April low. Most of the names, the common names out there, are up 25 to 48%. And we're now looking at some overdone signals on the upside. the big names, the Chemicos, the Denisons, the Sprott Uranium ETFs have had some excellent move, but look overdone. So our sequential counts are at 13 out of 13, and it looks as though they're ready for a bit of a pullback. The 50-day moving average is the normal one that you would see at this point in the early stages of a uranium move. So, hopefully there'll be an opportunity for people to get on here within the next couple of weeks, those that didn't get on board. The other standout is the wheat market, to which continues to see commitment of traders numbers as of this week going to multi-year lows, where these are at the speculators are net short, the most that they have been since 2017, and the commercials are net long, the most since that date as well, back in 2017. But the price levels have been eroding to consistently lower prices. So this market is primed for a pretty good recovery rally, and I think that the 20-day moving average should be used as a catalyst point. We this week's rally got up and tested resistance and backed off from there. I would suggest that the highs of the last 2 or 3 days would be a catalyst level. If we break out through there, you want to get on board and go with a rally, which I think, could be looking at somewhere around 650, and that would be from a level in the low fives. So pretty good move when it comes to anything as far as the grain markets are concerned.
Ross, thank you so much for the update.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in BC, but he's still very active in the markets. Check out his website, victoradair.ca. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Well, Jim, thank you for having me back.
Before we discuss individual markets, I'd like to get your take on some of the very, very wild swings we've seen in the stock markets. The S&P was at an all-time high in January, then tumbled by 20% by April, but since then, it's rallied back to close to January levels. Why are we seeing such volatility, and is it going to continue?
Why don't you start with the easy questions? Yeah. Oh, my gosh. Let's see. If we could put it in 3 words, it's all about Trump. How about that for an answer? I mean, it has, I remember in the past couple of years frequently saying it's all about the Fed, like that was what was important. But certainly that's changed. And you're right, in January we were at all-time highs. The market, I think, we'd had a great run for the previous 2 years. Particularly, a big cap tech that was sort of leading the parade. And in January, it's kind of like the cherry on top was, now we've got Trump and he's talking about the new golden era of American exceptionalism, and, it just doesn't get any better than that. And it didn't. Things started to, I think one of the first things happened, we had a little crack with maybe AI was not really going to work out quite the way the market had thought it was. Especially we had the outfit from China that came out and said, they'd actually built an AI model with about $5 and some spare parts they found, in the garbage can. I'm exaggerating, of course, but there's always something, right? There's always something that's a bit of a trigger. And in a market that's maybe got ahead of itself, to be polite, if there's a trigger, the things start to reprice. And then it turned out, the whole thing about tariffs just started to accelerate in terms of having an impact on the market. We had Liberation Day, what was that, 2nd or 3rd or something of April, and then in the days immediately following after that, there was kind of a tit-for-tat retaliatory thing between Trump and China, and at one point, tariffs on China were going to be 145% and vice versa back at you. So that was obviously, embargo levels. So that defined our lows in early April. I think it was the 7th of April, actually. We were down about 22% on the S&P. Things started to do better from there. We had what I've written in my trading desk notes described as a key turn date around the 22nd of April. And that key turn date to me is when a number of different markets all change direction on or about the same day. Okay, so the date was the 21st. If folks want to go and look at the individual charts and check that date out, you'll see that gold hit a high about then, the U.S. dollar hit a low about then, the stock market hit a higher low at that time, and even WTI got in on the act. So we had a turn there, and since then we've had this tremendous rally, and I'd say the fuel behind the rally has been headlines to the effect that, big, beautiful deals are going to be made between the United States and other countries, and tariffs are going to be much lower than what the market was worried about, and here we are. We've had a great run to the upside. So I think that's kind of been the quick take. We had extremes in sentiment in January, really bullish. In April, really bearish. And by the way, another way of looking at that sentiment was volatility metrics in the options model. In the options world, I should say. In January, vol was low at the stock market lows. In April, I think VIX was at about a 4-year high, as the market was just frightened, really, as to what's going to happen next. And as we've had the rally off the lows in April, the volatility's kind of back to the typical levels it's been at for the past year and a half or so. So, yeah, we had a real wild ride, but it seemed to be very much tied to the tariffs are going to get horribly expensive, and we're going to go into a recession and this and that and the other thing, and then no, that's not going to happen, and now we're back to where we started in January, more or less. So it's been quite a ride in terms of investor sentiment, or let's say the swings from really bullish to really bearish and back to really bullish again. So that's how I see it anyway.
In your weekly trading desk notes, you've pointed out that nearly all the world's stock markets have had a similar pattern of falling from January to April and then rallying back. Do you see any notable exceptions to that pattern?
I do. And as I think I've discussed with you a few times, I'm always looking at correlations between markets. It's just one of the ways I look at markets, and by a correlation, I would say if you got two things that are kind of going along together, as it were, and then that changes, and one goes one way and one goes the other way, you say, gee, why is that? And you start looking for reasons. So two markets I've noticed, and that is the Canadian stock market, let's call it the Toronto Composite, and the German DAX. Both of those markets have not only recovered back to where they were in January, they have now gone on to make new all-time highs. The Canadian, the TSE Composite, has closed higher for 6 consecutive weeks, and here we are at new all-time highs. Germany, much the same. Why is that? Is there anything these two countries have in common? And I would say yes. And that is both of these countries are, the governments are saying that they are going to really crank up fiscal stimulus, in other words, government spending, to get the economy going. In Germany, so dramatically, they had to amend their constitution so that the governments could go deeper into debt, or go into debt in the first place, to finance this government spending. And I guess the stock markets in both of those countries like the idea of aggressive fiscal stimulus to get the economy going, so the stock markets have been up. Now, there may be other things happening there, but I do see that. The Toronto and the Canadian and the German markets have been much stronger than some of the other markets around the world.
The U.S. dollar tumbled from January to April and has bounced back a bit, but not nearly as much as the stock market. Why is that?
Yeah, that's Well, let's see if I can muddle through an answer to this question. I mean, the U.S. dollar, I've described it in January, was at about a 3 or 4 year low, something high, I should say. But really, it was near like a 23-year high. We'd had a spike back in 2022, up for a couple of weeks. The U.S. dollar was higher than it was in January this year, but for all intents and purposes, the U.S. dollar was at about a 23-year high, and that's the U.S. dollar index that we use in the markets to as a shorthand for the dollar, and it's heavily weighted to European currencies. If you take the trade-weighted U.S. dollar, which has much more Asian content in it, the U.S. dollar in January of this year was at an all-time high. So it's way up there. And then when the world, as it were, started to wonder, what's Trump up to, the vulnerability of being at all-time highs and then some questions being asked, I think gave the U.S. dollar a good kick down, and we came off more than 10% on the U.S. dollar index into the lows in April. Now, it has bounced back some since then. Maybe we're up about 4%. Why has the dollar not been as dramatic as the stock market in the bounce back? I think fundamentally it's a different kind of market. I think the stock market is more, more prone to being driven by animal spirits, if I could call it that. Crowd psychology, where whether the market's going up and everything's wonderful, or going down, everything's horrible. Currency markets may be a little more level-headed than that. And I think there's still some huge questions out there about whether the full faith and credit of the United States is being put into question to some degree. The reserve currency of the world, the exorbitant privilege that the American dollar has because of its status as a reserve currency. I think there's some real rethinking about that. And now folks that have listened to me talk on your show over the past several years know I've been generally a U.S. dollar bull. And, I think push comes to shove, I'd rather have U.S. dollars than anything else. But I can see in the marketplace there's some questioning as to whether or not the U.S. dollar is the one and only. So I think that maybe is why it hasn't bounced back as much as the stock market has.
Gold was around $2,700 in early January, rallied around $800 to all-time highs at $3,500 in mid-April. It's fallen about 10% since then. What are your thoughts on the gold market?
Well, I have traded gold for, believe me, over 50 years. And I've seen a lot of things come and go with the gold market. This was a pretty spectacular run. And as I was saying earlier about correlations, correlations of markets go along and then all of a sudden the correlation changes. That happened with gold in a big way a couple of years ago, and I would say the key event was the Russian invasion of the Ukraine. When prior to that, the price of gold was usually pretty negatively correlated to the U.S. dollar and to interest rates. And I described it this way, that a rising U.S. dollar and rising American interest rates were like kryptonite to the gold market, okay? And so the U.S. dollar was rising, gold would fall, vice versa. And then after that invasion of Ukraine, that correlation broke down. And people like me, other gold traders, were saying, hey, what's happening? How come gold isn't having its, sort of historically usual relationship with the dollar? And that led us to look around and, the answer kind of became, well, central banks seem to be buying a hell of a lot more gold than they used to be, and that may be the thing that's breaking down the correlation with the dollar. And I think a lot of gold analysts around the world settled on that as the reason. And, makes sense to me. The reason for buying the gold, it seemed to be that the central banks didn't want to maybe be caught out if they got into a tiff with the Americans, and the Americans just said, okay, well, you're out of the system, or whatever. They wanted to have gold instead of U.S. dollar assets in their reserves and so on. Now, given that, the biggest buyers were the People's Bank of China. But China plays a much bigger role than just that. The Shanghai gold futures market is a place where Chinese speculators who want to participate in the gold market are going to show up. And we've seen some really, really big swings, big demand for gold in China. One of the ways of looking at it is the price of gold in the Shanghai market has usually been above, this is recent, above the price of gold in New York and London. To cut to the chase, I'm saying this in the speculative nature of gold. The price of gold is being discovered in Shanghai, not in London, not in New York. Those markets are just kind of following along the aggressive bidding that's happening on the Shanghai market. Now, that's great if you're a gold bull. You know, anything that drives the price higher, that's good news to you. But the thing that's perhaps worrisome about that, we've seen this in the Chinese markets before, whether it's gold or copper or even tech shares or whatever, that the Chinese markets seem to have this characteristic of everybody piling on. You know, market's going up, everybody and his dog's got to buy it, and the thing then maybe runs way too far too fast, and you get a correction. So I think maybe that has been a factor in the correction that we've had here, as you were saying, about 10% from the all-time highs. When I look at the open interest, I look at the volume in the New York market, it looks to me as though on that run up to the highs that people who were long gold were taking profits. People who were short gold were saying, oh, God, I'm wrong, and just getting out. And we saw a decline in the open interest in the New York COMEX futures. If New York had been leading the rally and there was aggressive new buying in New York, we would have seen open interest go higher. Now, whether I'm right or wrong on that, I mean, the gold price goes up or down, doesn't matter to some folks who's driving it. But I think the reason it's important to note that it was a Shanghai-driven market is because of this piling on effect that we've seen in other markets in China, which made gold a little vulnerable. And we've had some return here in the past 2 months to the correlation between a strong dollar, not good really, for the gold market.
The Canadian dollar hit 22-year lows around 68 cents February 3rd when Trump hit Canada and Mexico with 25% tariffs. It's now up to 72 cents. What drives the changes in the loonie?
Yeah, that was a pretty dramatic day on February the 3rd when Trump hit Canada and Mexico at the tariffs, and it was expected, or maybe people thought he wouldn't go through with it, but he did. But then, of course, a couple of hours later, they reversed gears on that, and the Canadian dollar had its biggest one-day rally that day that we've had in years. And since then, the Canadian, as you say, have come back, has rallied about a nickel or so. A big part of that, let me say it differently. When I trade the Canadian dollar, and I've traded the Canadian dollar as long as I've traded gold, I've noticed that the Canadian dollar more often than not is driven by things that are happening outside of Canada rather than things that are happening inside Canada. So again, if I say I look at correlations, I'll see that the Canadian dollar sometimes kind of trades in lockstep with the euro currency, which is the euro U.S. rate. So, in other words, if the U.S. dollar is going up against the euro, it's probably also going up against the Canadian dollar. Might be the simple way to say that. The Canadian dollar, I've also seen it trade virtually in lockstep with the S&P 500, which is my favorite risk barometer. So if the market's feeling frisky, want to take on risk, and the S&P is going up, the Canadian dollar in that environment would be going up as well. Over a longer period of time, you go back, let's say, over 20 years, and you look at monthly charts, the Canadian dollar often has periods of when it's highly correlated with the commodities market, in particular, the price of crude oil. And there's one last correlation, and that's a very important one, and that is the interest rate differential between the United States and Canada. If you could get 2% more on your investments by being invested in American Treasury bills than in Canadian short-term bills, that is a real drag for the Canadian dollar, or the other way around, likely to boost the U.S. dollar against the Canadian. So those are sort of the main things that drive the loonie. And from time to time, different correlations may be in focus. So I think lately, the Canada has been more tied to like the Euro US, or the impact, the up and down of the US dollar has been more important than certainly the commodity relationship, and also the interest rate differential, right? The Bank of Canada has been cutting rates more than the U.S. You look ahead, the U.S. is likely to cut less than the Canadian dollar, so that's been a bit of a drag on the Canada as well. But the overall thing here is the U.S. dollar was very weak from January into April. It's come back a little bit, and really the past couple of weeks here, Canada's kind of gone sideways, either side of 72 cents. So that's kind of the short story on what changes the loonie.
WTI oil was $80 in January. It's now been as low as $55 this month. What's the story on crude?
Yeah, crude has been, it's almost been like every time they turn around, they get more bad news, I guess. Crude is a really, really, really a supply-demand market. The Canadian dollar is not a supply-demand market. To some degree, the bond market is a supply-demand market. But with something like crude oil, it really is important what the supply-demand picture is. And there has been certainly thinking that there would be let's say when the stock market was falling from the January highs into the April lows, part and parcel of that was this is going to lead to the tariffs and the falling market are an indication that a recession is coming. Okay, that's going to be less demand. There was already thoughts that the rest of the world was maybe economically slowing down and there'd be weakness in the demand side. On the supply side of the question, we had a pivot here recently, and a fundamental pivot from OPEC, who had for the past couple of years been, say, managing the price of gold by cutting back their production a little bit, at least agreeing to cut back the production a little bit. And now it seems as though they're not inclined to try to defend the price anymore. They just want to sell more oil because they need the money. So, yeah, here we are, $55. The oil market has been, just generally speaking here, a victim of worries about weakening demand and worries about there's going to be more supply, and that just pressures the prices. So I think, from a top-down perspective, that's what it's all been about here, and that's what's taken us down to $55. Whether or not we could stay at this level, you do a what if. What if the United States cuts a deal with Iran? Iran can produce 4 million barrels of oil a day. Put that, if that comes onto market, whereas, right now we've got sanctions against Iran, that's a significant difference in a world where we consume, roughly 100 million barrels a day to have that much extra oil available. So there's some vulnerabilities. Turn it the other way around, however, if the United States and Iran get at loggerheads with each other and the market's worried about maybe military action, oh my gosh, you have to anticipate that the amount of oil coming out of the Middle East, and that's not just Iran, but everybody there, could be significantly impacted, and that would drive the price to the moon. So, yeah, some wild variables there, but I think the key fundamental here has been the supply-demand picture.
And news in today, China has now surpassed the U.S. as the biggest buyer of Canadian crude oil, thanks to the Trans Mountain Pipeline that ships out of Vancouver.
Well, Yeah, I mean, do you want to get me started on Canadian energy policies?
Sure, I'd love to hear that.
I got some really strong opinions.
That would be another 3-hour show, wouldn't it?
No, I could do it in just a couple of minutes.
Okay, let's do it.
I think right now the market is giving our new Prime Minister a bit of a honeymoon period. He's been in power for all of 3 weeks since the election, and we'll see what side of Mark Carney shows up. And I guess there's the opportunity for him to be the greenie that he seemed to be previously, or maybe now he's really going to say, Canada needs to recognize the wealth, the fabulous opportunity we have with the energy resources we have, everything from hydro to nuclear and everything in between. And, we should be taking advantage of that, especially given how we've been shown we have a vulnerability to the United States. So, as much as I would rather the oil go someplace other than China, but there it is, it's good that we have an alternative customer for our energy exports.
Before we wrap up, do you have any advice for our listeners about how to trade in these very volatile markets?
Well, carefully. I mean, one of the things that I do in a real volatile period is, I guess I'm pulling my horns, let's say that. I am always focused, Jimmy, on not pretending that I've got a great crystal ball. Okay, my success is going to be more dependent on managing risk. That's just the way I look at markets. And when markets are wild and crazy, my chances of having a good crystal ball are less. But there's something else that's a little more existential, and that is, right now, we've had this great rally in the stock market off the lows. The market sentiment seems to be very bullish. The ratio of people buying puts to buying calls is like nobody's interested in buying puts here. It's like the market's got nowhere to go but up. Seems to be the sentiment. And I'm going to post this existential question. Just what the hell are we trading? Okay? I used to say, I had these discussions with my son. We're both trading. I'd say that way about copper. I'd say, what are we trading when we're trading copper? I mean, have we got a pallet with a bunch of red metal on it, or we have got some kind of a financial instruments that has been hypothecated 6 ways to breakfast in an Asian market? What are we trading? What do you think we're trading here with this rally off the lows, up 20% in the S&P, on, we've got to deal with this country, we've got to deal with that country, we've got, all of this going on, and all these people from the Middle East are going to be investing trillions of dollars in America, and what a great show. Really? Is all of that actually happening? I think so far we've got a lessening of the tensions that were stirred up as the market fell and Trump was cranking up the stress level, I guess, on what tariffs could be. But I don't think we've got like a whole string of deals, and it's a done deal, as it were. I think the animal spirits have probably taken us a little too high too quickly here on headlines as opposed to substance. So, yeah, I think there's good reason to be cautious out there. And if there's just a quick throw in, we'll see whether or not the Americans can come up with a budget. I mean, so far, it seems as though, I don't know, is Congress even in session? I mean, does it matter? I mean, Trump just signs executive orders. But, they do need to come up with a budget, and it looks like they're going to have trouble doing that. So, long and the short of it, I think we've had a heck of a run off the lows here, the April lows. I think the animal spirits are giddy, and I will not be a chaser of this stock market right here, right now.
Victor, always fun chatting with you.
Thanks, Jim.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business, but he's still a very active trader. Check out his website, victoradair.ca. Coming up, Mark Leibovit, next on This Week in Money.
Don't miss out. Stay informed. receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Mark, welcome back to This Week in Money.
Glad to be back, Jim.
Mark, can you tell us a bit about VRTrader.com?
VRTrader.com started from a term that we created and registered called the volume reversal, which is our little technical tool that I learned and developed when I was a floor trader decades ago on the Chicago Board Options Exchange. Basically, volume precedes price in the market, so big volume comes into the upside off a low, let's say, for example, or big volume or increasing volume off of a high. That tells me smart money is buying or selling, and it's just a tool, and we sort of based our newsletter on it because it really is a great tool for following the so-called smart money, and it becomes a trading tool and even has some intermediate significance too. So individual stocks, commodities, the indexes, and so forth. So that's what VR Trader is. The company's name is Leibovit VR Newsletters, but we keep the shortcut URL VRTrader.com. Now we do a lot of other stuff, as you know, over the years, you don't want to use only one indicator or one tool. It's a great trading tool. I use it all the time. But we employ cycles and market sentiment and all kinds of good stuff to try to time the market. And since I've been doing this now 45 years, and I'm still doing it, I consider myself a survivor. And have been recognized over the years in the media and couple magazines as a top market timer. So no one's right 100%, but we're still doing it and still successful.
This week, the full moon was a full flower moon, the moon of chaos, clarity, and transformation. Is this full moon likely to be affecting the markets?
Well, I did some research on the flower moon, which is what they call this moon, and it is named supposedly for the abundance of blooming flowers that typically seen this time of year in the northern hemisphere. And there's some cultural significance to it. Native American tribes, for example, often called the full moon this time of year the budding moon or the egg-laying moon. It's if you scan all the moons, they all have these interesting little terms for it. But to go back to your question, the moons have other significance too. They affect not only tides on the planet, but human beings as well, since we are predominantly made out of water. And very little discussion about it, but we track them, and we find over the years that there's often some significant correlation. We've heard stories about full moons in emergency rooms, more activity during that period of time, the word lunacy and so forth tied to the full moon. And of course, the lunar cycle includes the new moon as well as the quarter cycles too. So since 1972, and this is going back a long time, I've been tracking the lunar cycles, and this was influenced by a program which many of the old-timers know was the Louis Rukeyser Wall Street Week television program on public television in the U.S. And at that time, I wasn't officially in my newsletter business. I was still in graduate school, but I was watching the show, and a fellow by the name of Ian McAvity, who was based in Toronto, who created a newsletter called the Deliberations, I think is the name of it. I met him over the years a number of times, very nice guy. And on that show in 1972, he said, well, you could see full moons and gold top out together or move together. And if you're going to see a full moon around a gold move, you're probably getting into a top of some kind. And it turned out over the years that the moon is more of a change of direction indicator than it is an absolute high or low. But I start tracking it ever since then, and all the cycles, and on my charts I pinpoint all the lunar cycles along with other indicators, and you definitely see a bit of a correlation. In fact, we had a full moon this past week on the 12th, and the market's been a little toppy phase here in the last few days, and really hasn't gone much higher or lower, and actually broke a little bit to the downside earlier in the week and tried to rally a little bit today. So I put out in the newsletter, we're probably hitting a little change of direction here with that full moon coming in with the market high, and everybody, enthusiastic now that the market had such a big move. So it's just something, that we watch. It could have intermediate significance. It could have trading significance. Looking out a little bit further, for example, we have a new moon on the 26th of the month. Sometimes you see change of directions around the new moon as well, but it's definitely something that the financial press does not touch at all, never. And I guess it's the fear of somehow being considered an astrologer or something else, but it's really geocosmics, geophysics, in terms of the impact of the moon on the planet and the impact of many of the other planets on the planet Earth as well, because there have been studies that show that, though it's laughed at, some of the top timers in my industry are astrologers. I guess the most famous one is an old friend of mine who's on CNBC almost every day, Arch Crawford, who I think he stopped publishing his newsletter, Crawford Perspectives, but I think he told me the story. He said, show me an analyst on Wall Street and I'll show you a closet astrologer. In other words, it's in their drawer, they pull it out, but they don't show it to anybody. And he was on CNBC for years, and I met some of the top astrologers who were traders, are actually on the floor of the exchange in Chicago. That's where I really met these guys. I had no interest in it whatsoever, and I run into these guys, and they're trading the market. And I think I've told this story before, but I'll tell it again since it's This Week in Money, and people like to hear some stories, I hope. I was on the floor trading, and one fellow, I don't want to mention his name, was an old friend of mine at the time, said to me, well, at 12 o'clock, you're going to see the market change direction. And I said, okay. And it had to do with some lunar cycle that he was tracking along with maybe some other astrological things. So I'm trading with him, and I have to tell you, I swear, at noon, the market reversed direction. It was up and then started to sell off dramatically immediately. My mouth fell open, and I says, what the hell did you do, or what the hell did you know? And he explained it had to do with the nodes of the moon and some other variables that caused him to make money and trade accordingly. So I immediately gained respect that there's something to this. And in the years since then, I joined a group in Chicago called the Astro Cyclical Exchange, which he was part of. And some of the top names on Wall Street, and I don't want to mention all their names, but you would know them. Many of them were involved with, or on national television and Mr. Rukeyser's show and PBS and so forth. But they were part of this group, and they would meet every month or so and compare both cyclical and astrological indicators along with the normal stock market indicators. So laugh as you may, listener, but I'm telling you, you talk to an analyst, and there's a closet astrologer there somewhere. It's been around for thousands of years. I am not an astrologer, but I read whatever they send me. And if it ties in with what makes sense to me in terms of the happening in the markets and so forth, I pay attention to it. So I got off on the tangent here a little bit with the lunar stuff, but it's all connected. It's very interesting, and it should not be ignored. And some of the top leaders of the world, from presidents to emperors, over the thousands of years have had closet astrologers. And I'm not here trying to sell you on astrology. I'm just telling you that I laughed at first, and then when I saw the results and see the correlation, I pay attention. So they don't talk about this on Business News Network or on CNBC or Fox News or Wall Street Journal and Barron's and so forth, because somehow people feel that you're crazy. Well, you're crazy for not looking at it. That's the bottom line.
Is this full flower moon likely to be affecting geopolitics?
It could affect everything. I mean, this is the question of the power of the moon and the planets and the geocosmics and what's going on. You know, we talked about solar activity and sunspots. I think we'll probably address that too. In fact, there's a bunch of solar stuff now being emitted by the sun. They say it's heading toward Mars, not to the Earth. You go to spaceweather.com and you can look up to see what's going on that's being tracked. Apparently it could affect the carbon dioxide levels on Mars when it hits the planet in the next couple days. But it affects the Earth, and, you know, all these things affect human beings. So if we're 90% water and the moon can affect tides, you don't think it affects human emotions and nature? And when you asked a question about affecting politics, I wouldn't disagree at all about that. I think it's affecting our whole being in some level, and it's just interesting stuff. Obviously, you can do all kinds of studies over the years, but I wouldn't discount it.
What other effects could this full flower moon have?
Well, I really don't know. I mean, other than, indicating, a change in direction of some kind here in markets and in politics or in world events, I guess it all could be coincident with it here, just because it has it's sort of a timing mechanism of some sort. And it has to do with, gravitational pull, and I suppose a lot of physics that I'm not knowledgeable enough to describe, but it's here. And we just have to watch all those cycles and see where they tie in with where the market is or where the politics are. I mean, they're talking right now that I just got some news that Iran is ready to sign a deal with Donald Trump over getting rid of their nuclear bomb projects. So they want to apparently keep some of the nuclear material for, domestic peaceful uses. And this just came out in the last few minutes. Did the moon have something to do with that? I don't know. I know a lot of things are happening in the Mideast right now with trillions of dollars being invested by, I guess, Arab countries because of Donald's trip over there. A lot of interesting stuff's happening right now. So the power of the universe, Jim, does that work?
Does it look like the stock markets could hit new highs this year? I
am very bullish, have been. We put out a forecast model, which you can subscribe to at vrtrader.com. It's called the VR Forecaster. Came out at the beginning of the year, and it totally predicted the sell-off that we saw into April. And you got to get your hands on it because it also tracks other markets besides the stock market. There is a discount available. Email me at vrtrader.com, mark.vrtrader.com, and I can talk to you about that. But I would say, we're in a position where the market will likely see new all-time highs and go beyond that. So you've got, a lot of political stuff going on, potential tax cuts, tariffs that probably are going to work, a lot of deals that are being done, and, big changes occurring and overturning a lot of bad economic policy. And, a lot of people panicked. And, it sounds political, but I think, they sold the market down in March and April because they don't like Trump, not because tariffs would be negatively interpreted or affecting the business world. It was just, anti-Trump sentiment of sell everything, which was nonsense. So a lot of companies are still making money. Corporate leaders, executives are smart. They know how to adjust themselves to changing business and economic conditions. And we have an accommodative Federal Reserve here in the U.S., though I've for years touted that the belief that they should be abolished. In fact, there's a couple bills in the U.S. Congress about doing just that, which is not going to happen but should happen. But the Fed has been very accommodative. There's a lot of discussion about interest rates. I'm sure we're going to get into that, but they've been expanding the money supply. So regardless of the nonsense about what rates are doing, money's being pumped into the system, and that's going to drive prices higher. And that's just the bottom line.
Could there be a double top in place for gold?
Yes, on a trading basis. In fact, we were bearish in our previous few interviews. I believe I did discuss with you that we hedged on the short side. What we did was we bought some inverse ETFs, exchange-traded funds, on gold itself and silver, thinking we would get a little pullback here, and we got a little too exuberant here to the upside, and gold and silver did come down a bit, and they had a nice little sell-off. So hit a little top. I don't know about a double top, but it was a top. And, I'm not a bear on gold. I've been in it since the 1980s, and, you just have to be ready for the volatility of the market. So I'm still a long-term bull, but, you have to make your own decisions on a short-term basis, and it definitely got carried away here. And the thing to think about, and others believe this as well, is, much of the move in gold has to do with geopolitics and the state of the world in terms of war or non-war. And some of the big push to the upside in gold came after Hamas invaded Israel over a year ago and a year and a half ago almost. And, we still have Ukraine going on, and, hopefully something resolves that. But the Iranian story I just mentioned is important. So a lot of the move in gold has to do with fear of conflicts and stuff, not so much inflation or, Federal Reserve and other issues. So if the world quiets down in terms of geopolitics, that puts less upside pressure on gold, and you might see even more of a correction. I mentioned last week, I think, at our weekly interview, and I'm not predicting it's going to get there, but there's a number way below the market in gold, like 2,400, and it's now around 3,150 or 3,170, and it got to 3,400. So there's a number on the charts that if something dramatic happened, it could sell off 1,000 points from its high, find support in that level, and then take off again from there. It's possible. It's just something you look at on the charts and you say, can this really happen? And we've seen 1,000-point corrections in gold before. So we'll see. I'm not selling the gold coins in the vault or anything like that. I'm just saying, as a chartist, you look at the possibilities, and it's there. It's on the list as something, that could happen, and you have to be psychologically prepared for it and act on it. If it did get down there, there'd be one hell of a point to add to a position. So particularly if you think is gold going to 4, 5, 10,000 or some big numbers, which could happen. We have a Federal Reserve chairman who's going to be leaving in the mid-2026. There's one gal, I mentioned her name before. I'm not saying she'll be initiated as a replacement or recommended as a replacement, but her name is Judy Shelton, and she's very pro-gold in terms of backing the treasuries and the Federal Reserve and so forth. And if she gets in, that's very bullish for gold in terms of pegging gold to what we really have here is a very volatile and unstable dollar and financing situation in this country since it's not backed at all. Remember that story? What was it, was it 1890 or 1906? I forget the exact date, where J.P. Morgan, who apparently had more money than the U.S. government, bailed out the U.S. government. They needed money badly, and apparently he supplied them with a ton of gold, the equivalent, 100 million or some huge number at the time to bail out the U.S. government. So gold had a big part in saving the U.S. finances at that time, and J.P. Morgan came through with that. You can read about it more. It's all chronicled in the historical archives about what he did. But I think as a result of that, the government historically has been very pro J.P. Morgan and J.P. Morgan Chase, which, as you probably know, is the world's largest bank. I think the stock hit a new high today, if I'm not mistaken. So, basically J.P. Morgan Chase and J.P. Morgan history tied to the saving of the U.S. going back to the turn of the last, not this previous century, the century before that, is, really an interesting story and insight. But anyway, I hope I covered your gold question.
Silver's been trading sideways. What do you see ahead for silver?
Well, I posted an article, my newsletter, was it yesterday or the day before, about one very very famous analyst thinking that it could get to $100 an ounce in the next few years, and I think that's possible. I mean, there's been a lot of demand for silver. A lot of the real silver is not there. A lot of it is traded in futures contracts. It's been suppressed and manipulated over the years. So I think you own it. I own a bunch of coins. I don't think that's, if it triples from here, which could happen, that'd be great. It would equate to some of the returns I'm looking for in the crypto market. which would make it an equivalent. If it's as slow as it's been the last few years, it's going to be a very, tough, investment for you to monitor every day when it's not really moving. But the fact that it didn't go to new highs when gold went to new highs was a bit of a negative, Jim. It should have taken off more than it did. So there might be some suppression of the price still going on out there. There's been cases filed. Some won in court. You can read about them. And I don't want to mention the firm, very famous firm that was involved in the manipulation and suppression of the price of silver. And there's a lot of articles you can pull up on it, whether that's all going to go away or still out there. And you ask, why is that the case? Well, from my understanding is there isn't enough silver to make delivery of a lot of requests for delivery. So the government or its co-conspirators are out there selling futures contracts, with an infinite money behind them and keeping the price down, because when people come in and try to exercise delivery, it's not really there, and they try to keep the price low. And there's a lot of articles and research you can do in Google and read about all this kind of fun stuff. So that may be part and parcel to the fact that silver really hasn't done as well as we had hoped. But I think you look at the charts, it's sort of a big picture uptrend technically, and it will break out. And I don't, it could be 10 years from now, or it could be 2 years from now. You just don't know. But more geopolitical instability is going to help gold, I think, more than silver.
Do you think the bottom is in for the U.S. dollar?
I think so. We had a nice shakeout in the dollar. Everybody got really bearish on it. And it looks like it hit a bit of a bottom to me. So I'm staying long the U.S. dollar, technically. I think it did have a correction, and I think it could recover here. I think everybody gave up on the dollar too quickly. The Democrats in this U.S. or others may hate Donald Trump, but the world loves him. And the world loves him is just evident what's happening right now in the Mideast with the deals that he's carving out. And that's good for the U.S. dollar. I think he mentioned in some interview today several trillions of dollars is going to be invested because of his trip. And that's going to help U.S. business, U.S. companies, going to help the U.S. dollar. So you got to be a bull. It's a Trump move.
Does it look like crude oil put in a double bottom?
I'm not that bullish on crude oil. I still think it's going lower. You say double bottom on a trading basis, maybe, sure, but I'm one of the few that was out there when it was in its 70s predicting that it was going to 55, which is where it went, and I could even see the mid 40s, and I think oil companies can still make money even at lower prices. They've shown that before. And it's really bullish for the stock market. The lower crude oil is, the better it is for business, airline business, fuel costs, gasoline prices for people everywhere. High crude oil prices are a tax on consumers and business. So I hope that I'm right, and if we have a double bottom, it's temporary, and we come back through that $55 level and maybe move into the 40s and see if that happens. And I'm not saying it's happening next week, but during the course of this year, it could. And that's, again, a bullish event for the stock market. So let's see if it pans out as I hope.
Bitcoin is close to its all-time high. Do you think Bitcoin's going to see new highs soon?
Absolutely. I'm surprised it hasn't already. Started to move here the other day, got up to 104,000 plus, and it started to pull back here the last couple of days. Short term, I was looking for 110, 111. Then after that, 145. You got to be in it. I can't tell you the second, but you're going to come in one Tuesday morning, and suddenly that something was 100,000, could be 150,000, and you're going to wish you were in it, and it could end up being 500,000 at some point, in the next few years. So remember, the U.S. government, well, it's not U.S. government, it's Donald Trump's proposal for a Bitcoin reserve and a crypto exchange reserve for other cryptos. So you're going to, he's built momentum on this. So it's like saying, do you believe he'll be successful? And if the government, the U.S. government in particular, is behind it, why would it go down? Something happens, God forbid, to Donald Trump, or something happens to this whole plan. Of course, something could change, but the world has accepted Bitcoin. And when Larry Fink at BlackRock which is the world's largest money management firm, several trillion under management, created the Bitcoin ETF, or exchange traded fund, which started trading in March of 24. That was the golden kiss, so to speak. That's it. So the largest money manager in the firm got the U.S. to create an ETF for Bitcoin, and this is like the World Gold Council getting a ETF created for gold, which was eventually became GLD, which is the gold ETF, and that creates buying for the underlying product. And that helped gold over the years move higher. It's going to help Bitcoin go higher. And right now, as I mentioned in the previous interview, you have 18 firms. I think one just got approved, looking to create an ETF, exchange traded fund, on another crypto called XRP. Trades about $2.50. So you got about 18 firms wanting to create an ETF for XRP, and it's trading at $2.50. Now, where do you think, if these all get approved, where do you think XRP is going to go? It's not going down, I'll tell you that. And something at $2.50 is a steal in the crypto world. When you look at Bitcoin at $102,000, or others that are trading significantly higher, there's other cryptos out there like Litecoin and others, and you can go through the whole list. It's in my newsletter. They're trading multiple times higher than that. So take a look at it. It's something to be aware of, and hopefully you participate in.
Last week, the Fed left its trend-setting rate unchanged. Is this likely due to, what's this likely going to do to inflation? Or is this likely due to inflation?
Well, it has nothing to do with inflation. All the experts will tell you it does. What it really does is the money supply and what's going on internally in terms of the other Fed activity. To give you an example, the M2 money supply is about reaching its highest level now in the last 3 years, and it's been rising for the last year and a half. That means the Fed's pumping money into the economy, and on top of that, general bank loan activity and lending activity is also sharply increasing now. And you say, well, why is that if interest rates are high? Well, somebody knows something. So these are charts that you can pull off from the Federal Reserve and other sources, and I'm looking at them right now, and it paints an extremely bullish position. And you're saying, well, why isn't rates going down? Well, rates will go down, but it doesn't mean that's what's going to drive the market or the economy. You know, I financed a house in 1979 or 80. I'm trying to remember the time. That's when Paul Volcker, if you recall, drove interest rates to 20%, and everybody thought it was the end of the world, and he was the Federal Reserve chairman at the time. You couldn't get a mortgage. Mortgages were 15%, 16%, crazy numbers. I got a mortgage for 11% on a house, I believe it was 1980, and I was happy because rates were 15, 20%. Okay, so where are rates now? 6, 7%, and people are complaining. You can make plenty of money at 6, 7% interest rates. People were making money when it was 11, 15, 20%. So it's all psychological BS. So, lending is up now. The Fed, whether it raises, lowers, or does anything to raise is sort of irrelevant. It's more important that crude oil goes down, I think, and that's more of a tax on consumers. The tariffs are probably going to help out. The government spending is going to help. Cut back in government spending is going to help. If they pass the tax legislation, which eliminates tips and so forth for being taxed, and they lower general taxation levels, and particularly if they bring that long-term capital gains tax down to 15%, companies from all over the world are going to move into North America and U.S. because of the preferable tax rate, and that's going to be tremendous boom to the economy and to the stock market. So when will the Fed ever come along and lower rates? I mean, if they never do, it doesn't change any of this. And what you really got to do is watch the bond market, the Treasury bond market, because it's the tail wagging the dog. 20, 30-year bonds are in their own world. They trade. Actually, they rallied today. There was a little up day in the Treasury bond market. A little volume came into the upside. So when the bonds rally, that means rates go down. This is talking about the long-term bonds. So they really determine what's happening. The Fed is just, it's like I say, the tail wagging the dog. Most of the money is in bonds, not what the Fed dictates. And at some point, you'll see the signals from the Treasury bond market, and we'll rally today. If that continues, eventually it'll force the Fed's hand, and we'll see how this all plays out. My prediction is they will lower rates, but it doesn't really change the economy. In other words, we don't need rates back down to 3% for things to be successful, is what I'm saying. The difference between 6, 7%, and 3% is just the number. And compared to history, as I cited in my example before, is sort of, irrelevant. It just, the financial press, a bunch of, really income poops. They talk about things that are not really that relevant. The psychological factor, so people, they want to buy a house, and if they have a job and they're making money, they can get the finance, they could buy a house. So they pay 6, 7%. So what, So they're waiting for 4 or 5% again. They may never buy that house. So I just think it's got to watch the bond market. I feel that the rates will come down a little bit at some point. It'd probably be forced down just from political perspectives. And maybe if they get rid of Jay Powell and we have to wait till mid-2026 and we get a new Fed chairman in there, maybe things change a little bit. But again, that's not going to change any of the outlook, in my opinion. I'm bullish regardless. So that's my opinion.
Is the U.S. economy looking bearish?
Not at all. I was writing about this late last year that we're going to see a little bit of recession. And in a way, we sort of had that, or having that, because of government layoffs. We laid off a lot of people in the U.S. government. A lot of the money spent by the Biden administration in the final quarter of 2024 was government spending up the gazoo, trying to stimulate the economy. It wasn't industry doing it. It was U.S. government spending, particularly employment. They hired tons of people. So all these people being laid off or not being hired. So indirectly, that sort of, helps propel a possible, a little recession of some sort, which, I guess we're sort of experiencing now. But, does that affect the stock market or interest rates? Yes, but they look into the future. So the big recovery we had here in the stock market since the April lows and what's happening geopolitically around the world and everything tells me that we're going to do great. And the recession, though it may be, it's minimal. And I'm more concerned about what the markets do because I'm in the markets. It's not like I'm looking for a job. I guess there's a lot of unfilled job positions because people are not trained for those positions. So you have to train yourself for the positions. And also, if you're willing to do other work, industrial type work, not necessarily doing AI or computer programming, there's plenty of industrial type jobs out there as well. So, there's a shortage of skilled people. And I think that's really the key here. But backing up to my comment, I'm looking at the markets, and the markets tell me the future. That tells me that any recession we are experiencing is temporary. So that's my opinion.
Are the U.S. real estate markets looking bearish?
No, they're actually looking bullish to me because everybody is bearish on it, and everybody's thinking it's going lower. And there have been some prices that have cut back a little bit because of this psychological interest rate story, which again I think is a bit of nonsense. People want to finance their homes, and they're waiting for rates to drop substantially, which they can hold their breath for a long time. I don't know how long it'll take to get down to the numbers they want. They probably will never do that. There's a shortage of housing. If you look at the charts of the home builders, which I chart, they're extremely oversold. They discounted everything in terms of pricing, and we're actually long the home builder index because this tells me that we've washed all the bulls out. Everybody is bearish, and you're at a bottom. So you'll start to see, I'm saying tomorrow, but the next 6 months or so, you'll see home prices start to recover, hopefully tied to a psychological plus that the Fed lowers rates, but it may not have to tie to the Fed lowering rates. The bond market could do its own thing, as I mentioned. Mortgage rates could come down not what the Fed does, but by its own free will and free market activity. So if the Fed lowers rates tomorrow, does that mean mortgage rates necessarily come down? No, mortgage rates are pretty much tied to the 10-year Treasury and to the 30-year bonds and what the big bond market is doing. So if everybody's waiting for the Fed to do something, they're going to miss the boat. So that's my opinion. I'm bullish.
Are President Trump and Elon Musk doing a good job with Doge?
Fantastic job. And you can tell because of all the aggravated Democrats out there in the U.S. Political world, because things that should have been done and have been talked about, there's all these recordings you can pull up. You know, it's a very great news network called Newsmax here in the U.S., and they pull up a lot of stuff, you know, and showing how all these other presidents or former U.S. presidents were talking about government waste and cutting back and doing all these things, but nobody did anything because it was politically uncomfortable. And Trump and Elon Musk, through Doge, have broken that barrier down and starting to clean things up a bit and doing what everybody else has talked about. It's like recognizing Jerusalem as the capital of Israel. About every former U.S. president has been talking about it for decades, but nobody would do it but Trump. The same thing with the cleaning up the economy. It's like nobody's got the balls to do anything. And finally, we got a president there who's actually willing to take the risk and do this stuff. So, let's clean it up. A lot of government waste and spending, a lot of pork, as they say, in the budgets. A lot of, stuff needs to be fantastic. And having someone like Elon in there, of course, he's backing off a little bit now. I hear he wants to concentrate more on Tesla, which, by the way, has exploded. I mean, everybody thought Tesla was going to zero. It dropped from almost 500 to 216, and now it's back to 350 in the last couple of weeks. And, of course, we love it, so we have it in our list of some of the stocks. But you can't discount a genius and his help with Doge and the U.S. government, and a man who's going to be getting Earthlings on Mars and creating all kinds of interesting technology. He was one of the creators of the AI. I mean, you got to bet on Elon Musk and anything he touches. So that's where I'm at.
Does it look like the tariffs and trade wars are working for the U.S.?
Yes, and we're seeing countries coming to the table, looking to make deals. Looks like China may eventually, not eventually, there's signs that they want to talk and get the tariffs equalized. And, Britain made the deal already. And, I don't have the list in front of me, but a lot of in discussions. Listen, there was an inequality here in the tariffs. I mean, some were 100% on U.S. goods going into foreign countries. I mean, it's totally insane. And in Canada, you got a mess. Apparently some provinces have tariffs moving from one province to another. And there's a mess even within the Canadian country itself, not to mention its dealings with the U.S., but they're one of many countries that we need to have a level playing field here. So, again, here's a information that's existed in the front of other market politicians and market players, but presidents for decades, and finally we're getting somebody to do something about it. Yes, it's uncomfortable short term, and everybody's squawking, and they start squawking about, prices going up a little bit. But meanwhile, food prices have come down, egg prices have come down, a lot of stuff that everybody was all excited and hot and bothered about. So, nothing happens overnight. But if we can create a level playing field for business around the world, that makes sense. And, why would Trump be so successful in the Mideast on this current trip with trillions of being invested in stuff if he was taking the wrong tack? He's obviously on the right path here. So, the answer to your question is I think the tariffs are great. They should work out, and it just takes time for programs to be implemented. I remember when Ronald Reagan was going way back, looking, in the late 1980s, it took a couple years for some of his programs to actually kick into the economy, and, the results weren't immediate. So I know everybody's looking for immediate gratification, and the politicians are worried about the midterm elections, coming up and how that's going to affect politics here in the U.S. So, they're worried that they want to see instant results. So we'll see if all that plays out, but I think it will if people stick with the program.
Canada has a new Liberal Prime Minister, Mark Carney. From the outside looking in, does it look like Canada could split up?
I don't think there's a rule in Canada about, or any formal method of secession. I guess there wasn't in the U.S. when South Carolina seceded, then started the Civil War in the 1860s. But there's a lot of unhappy Albertans out there. There's a whole, group that have been talking about, what's wrong. And, I pulled up an article about this. Basically, Alberta seems to be more in the separatist category, though, as you know, other provinces in the past have had some complaints, Quebec in particular, but apparently they're unhappy about the equalization payments. Apparently, what tax dollars are coming back to Alberta, for example, they feel they're unrepresented in Ottawa. They're worried about federal regulations, and some that just say, leave us alone out here, let's do our thing and mind your own business and what's going on in Montreal and Toronto. And, there's more of a conservative mentality. Part of it has to do, I suppose, because they're in the oil and gas business so much, and I know you have a background in that part of the world. So it seems like Alberta is probably the one that would be looking to separate, but whether they really can legally and, leave the country, whether they would join the U.S. or not. I don't think they necessarily want to join the U.S. I just think they want to be left alone to do their own thing and, be conservative and not have to deal with Eastern liberal politics, which seems to be what Carney is all about. And he's probably been probably the worst choice for leader in your country. Getting rid of Trudeau was great, but unfortunately, I think he's as big a mess as Trudeau was. So I'm making political comments here. I should, but we need a conservative government, more of what the Alberta constituents are looking for, I think. So we'll see how it all plays out. But I think, unless Canada comes to terms with Trump and there's some settlement here about the drugs crossing the border and about equalization of tariffs and so forth, I think the dispute may go on a bit. But Carney went to visit Trump the other day, and Trump didn't go visit him. So ultimately, Canada's going to have to concede, I think, in terms of, settling up in some fair business dealings. So, but as far as, separating and secession and that kind of story is joining the U.S., that's all over the top here right now. I don't know where all that's going to go. I just think there's going to be some changes. We'll have to see how it plays out.
Do you think the U.S. is likely to split up?
If the Democrats get back control in the U.S., then I would say yes. If the Republicans could stay in control, the Democrats are mentally ill, I feel. They're crazy. And in certain aspects, they've been traitors to the country and just allowing immigrants to come across unfettered, supporting males and female sports, supporting illegal immigration and criminals, on and on and on. You have a mentally unstable group. So if they take power again, God forbid, then, you'll probably see secession talks in the U.S., probably led by the state of Texas and maybe Arizona and others. We'll see. But, it could happen. And I hope that the mentally ill don't get back in touch in the control of the U.S. because obviously they were there and they've done a lot of damage up to this point. We're trying to straighten it out down here. It's not a question of being Republican versus Democrat. It's about thinking clearly and using facts and logic and following the law, not your emotions or some woke mentality, common sense type stuff. You know what I mean? So, I'm not a super religious guy, but, I follow the Old and New Testament and I follow the rules of, God. And the left and Democrats don't want that. If they did and they followed the Ten Commandments and law and order, then I think we wouldn't have had the problems. But we have, unfortunately, a lot of people that are really messed up in that party. And as far as separation from the country and breaking up, yeah, you keep those kind of people around. The majority, as we saw in the U.S. election this past year, don't want that. So if they come back in power, separation or secession may become a real issue for this country. So hopefully that doesn't happen.
President Trump's been in office for over 100 days. How would you rate his performance?
Super. I mean, he's done more in 100 days than many presidents have done combined in all their tenure. He's worked like a dog, done a great job, facing, unfortunately, the same enemies as before. But the world loves him. The Democrats don't like him, but the world loves him. And, of course, a certain majority in the U.S. love him as well. So I would rate his performance as great. I think he's doing a great job. I just hope he stays healthy and we don't have any more of these assassination attempts, because I'm sure there's plenty of people who don't want to see him around.
What's the latest on volcanic activity and sunspots?
Oh boy, a lot of interesting things going on there, Jim. Let's see what we can pull up here. Overall, there's 47 volcanoes that are continual eruption here on the planet, and this is as of May 2nd. This is put out by the Smithsonian Institution. So you got 47 volcanoes active on the planet right now, and that's not a good thing. It's an expression of instability on the Earth's crust, all kinds of potential risks of a super volcano type explosion affecting the atmosphere and suppressing the sunlight, which could affect the growth of crops and so forth. It also increases the chance of more earthquake activity and tsunamis and so forth and so on. So a summary is we've got a lot of activity on the planet. And the sun shines, it may be calm, in Vancouver today, but you've got even just off of Vancouver, you got a big fault out there in the Pacific Ocean, and there's been some earthquake activity and a lot of stuff out there that's related to the volcanoes around the planet. Just a whole unstable crust on the planet. So nothing much we can do about it. We can look at it, study it, observe it. It's in God's hands, not ours, but it's definitely, they're active out there. So we hope that we don't have anything super, explosive take place. It will at some point. It has over the course of Earth's history, but that's the story there. As far as sun activity is concerned, there's the one I mentioned earlier. Apparently, there's some solar flares headed toward Mars here that apparently can affect their carbon dioxide levels, and nothing headed to the Earth right now. So, but there has been an increase in solar activity, and it's going to be increasing more according to the studies that I've been reading. So that's not good news for us, because at some point, unfortunately, we could experience a repeat of the Carrington event from the mid-19th century, which fried the Western Union lines at the time. And going back into ancient history, there was apparently a solar flare that was so significant that it created, they found along the planet this black level of sediment that dates back, it could be 30 million years or some number, but apparently at that time there was a solar flare that was so powerful that it fried everything on the planet and just killed about everything, and it left this black ash layer that they found geologically. So the sun is certainly capable of destroying the Earth. It could do that at any moment, could have a sudden solar flare or explosion, and these minor ones that we've been talking about, increased solar activity, could be relatively minor, including the Carrington event from the mid-19th century. So it's just something we have to live with. It's just a part of the geocosmic sphere, and it's fascinating stuff to track. I love tracking it and following it. Obviously, if something big happens, there's nothing we can do about it, and hope that we survive through it. But it's just fascinating study of the universe and our solar system and what's going on out there. So not everything is, our destiny is not only related to politicians or the Federal Reserve or what Iran does or Putin does or Zelensky does. There are forces outside the human sphere, in the geocosmic, that could cause a lot more damage or benefit than any human being. So it's good to keep that perspective about what really our life is about, and what forces are really about us and control us in ways that we just don't really want to talk about or admit. And many of the religious will say it's all in God's hands, nothing to do with geocosmics or humans. It's all God that makes the decision. So it's just great stuff to talk about and philosophize about.
Mark, can you remind us again how people can sign up for your newsletter?
Yeah, please go to vrtrader.com. That's VRVictorRobertTrader.com, and that takes you to a homepage, and you'll see all our newsletters, and we cover most of the major markets in there. I'm particularly proud of our metals resource letter, which you can sign up for, our market timing letter, and our blockchain crypto letter, which I think is one of the most exciting opportunities you could be looking at right now. vrtrader.com.
Mark, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money.
Thank you very much for inviting me.
When's the next issue of the Campbell Real Estate Timing Letter coming out, and where can our listeners subscribe?
I'm finishing it up right now, the May 15th issue, and that you'll be able to read it at realestatetiming.com.
Are things changing in the real estate market, or as they change in the market today? Is timing the real estate market still valid as it was when it was first published?
Absolutely. That's what's so amazing, that I made this. I started analyzing timing indicators and created a model for timing the market and using markets, and that went back to I first published my book in 2002, so we're 24 years later, and it still works great. And I've learned a lot of new indicators as well, and that's why I'm writing a second book. But everything I published in the past works great. And what you find out is every cycle is different. I mean, all of a sudden you need more than just a red light, green light type of a system for timing the real estate market. That there's a lot of art involved and experience involved too. You can't discount that. So it's I'm in an exciting business.
The real estate market's connected to the economy. How's the U.S. economy doing?
The U.S. economy is kind of slowing down, just like real estate. When you say the real estate market, from start to finish, building a home and selling the home and doing everything to it, landscaping the home, constitutes about almost 15% of the U.S. economy. So the U.S. economy is kind of stuttering now because home building is stuttering. The construction business is stuttering. We're not building as many homes. Remodeling's down. Real estate activity is down, way down. I mean, you look at, going back 3 years to 2022, when there was a peak there, that was peak COVID prices or close to it. Since that time, home sales have fallen 40% and stayed down. So all the industry that was counting on, X amount of dollars, in 2022, now has 40% less dollars. So there's been a big shakeout in the business too. That's the interesting part of the cycles. But it's prices are still going up.
How's real estate doing in the U.S.?
Real estate's doing it's doing, I would say, well. It is doing well. That the year-over-year rates of appreciation have fallen for about the last 8 to 10 straight months. The annual rate of growth, but it's still positive. It's been coming down so slowly. Right now, nationally in the United States, I think it's CoreLogic. It's their year-over-year price increase is 2.5%. So that's still not bad. Things are still going up in value. So that's a fact. So the real estate market's good if you own it. If you're in the business of building it or selling it or financing it, no, you're having really tough times right now. Your income just got cut by 40%.
What's happening with prices in Florida?
Well, Florida went through a real boom. the boom period. A lot of people left California. I know there's a lot of people in California, and a lot of them left California to go to Florida, to find their to make their fortunes. So and that was like 2 or 3 years ago. So and prices kept going up. Now I understand they're having a hard time over there. It's being hit by too high prices and too much inventory coming in. I'm sure there's other reasons too. Like how about some of these homeowner policies that have gone up 500% over there? Pretty soon people can't. That's got to come out of the price.
At last week's meeting, the Fed left interest rates unchanged. What's happening with mortgage rates?
They've been going up slightly. I think in the last 2 months or something, 3 months, they've gone up from like 6.6 to almost 6.9% currently. So they've been going up. They haven't been going up a lot, but the Fed's not raising rates right now. They haven't cut rates, and mortgage rates are still going up. So that's always an interesting diverse, change that you rarely see, because they both usually work in concert. So, one of them's wrong.
Is inflation under control?
I don't think inflation is ever under control, but no, I do not think it's under control. In fact, I almost know that it's not under control, because the biggest driver of inflation is U.S. deficit spending, and we've been deficit spending like $2.5, $3 trillion, if we really know the right number, for the last 2 or 3 years. Deficit's going to be the same this year. And so, there you have, over $2 trillion of stimulus being injected into the economy via spending that isn't paid for with tax revenues, and it acts as a real adrenaline boost to the market. I think that inflation is the problem.
Is debt still the elephant in the room?
Yep. Well, I mean, it's not even an elephant anymore. It's like Mount Everest. It's like we owe $37 trillion U.S. debt, federal debt. Okay. I don't know what it comes down to for the whole population. If you divide that by 330 million, which includes little babies and everybody, I think we all owe $100,000 each. I mean, to exhaust that debt, maybe more, but whatever. It's never going to get paid off. And right now, and with interest rates rising the way they've been rising lately, with all that debt that's been piled on, I understand that the amount of money that we spend, the federal government spends right now in for debt financing is 22% of all the money they spend for debt financing. You don't have to go back that long ago where it used to be something like 10%. So it's doubled. It's $1.2 trillion now just to pay interest on that $37 trillion debt. 22% of the economy. I went, whoa! So what does it? That's huge. I mean, especially when you add in all the mandatory things. Pretty soon, if you add defense in that, there's no money for anything else except those items. Social Security, Medicare, defense, and servicing the debt. I mean, there's going to be no money to run the government. I mean, which is probably about 15-20% of the government of the budget. So it's totally out of control.
What's happening with housing inventory in various markets?
Well, of course, it changes between various markets. The markets in the United States right now that are the strongest have the lowest, have inventories that have risen the least in the last 5 years, and the markets that are having trouble, the most trouble, such as like Austin, Texas, let's say, they went through a huge boom, and all of a sudden they went bust, and prices are down 10%, and inventory has shot from it's coming into the market like crazy. So I expect someplace like Austin, Texas, which was a boom town, I expect they could very easily, revert back, lose 40% of its value, or even more, reverting back to the mean. So that's a very risky market.
Could tariffs be having an effect on the housing market?
I guess. I mean, from what I hear about these, I don't even know what to say. What the effect is going to be. I mean, I certainly don't believe what they tell you on TV. And what they're telling you is like all the people that hate Trump, for example. Oh, his tariffs are ruining business. All these small business people are going out of business. I don't know if that's true or not. I mean, but and the prices of something's go. The small businesses, they're losing their jobs in record numbers. If that's the case, yeah, it's going to hurt the economy a lot.
Would it be fair to say there's been a COVID housing bubble?
Oh, absolutely. From 2020 up through just go to today. Let's say we're still in it, even though we're technically not. So in those 5 years, U.S. housing prices, according to CoreLogic, national home prices went up 51%. They went up 51% in 5 years. That's a huge spike in prices. Huge. 5 years, up 51%. So yeah, it is a bubble. And COVID did cause. And who in the world knew that was going to happen? Nobody. I mean, nobody knew. I mean, anybody that's honest, and obviously you say, who would have predicted that? You would have predicted just the opposite, that things would have crashed. Instead of things went through an unbelievable boom, which goes to prove that I don't care how good you are at tracking markets, there is a degree of uncertainty in every one of these markets that makes you that never happened or doesn't happen much in the past. So you can't even see it coming, and then it hits you. That's the risk there is in life in all these markets. But it went shooting up like that. I mean, for all I know, anybody knows, if it goes shooting up like that in 5 years, maybe it can come down like that in 5 years. Maybe things are that inflated. Hey, I could see that happening in the Austin market. That thing is just got way overvalued. Way overvalued. I mean, we're talking about Texas, right? We're not talking about Santa Monica or something. So it's just I think it's a huge bubble, and I anticipate a very severe correction there.
Following the housing bubble, can we see prices for the average home return to 3 to 4 times annual income?
Well, that's been an old rule of thumb. And after this cycle peaks and we start heading down, I would say that the bottom of the cycle will be marked by 3 to 4 times income.
Now, is it a high risk or low risk time to buy a home?
Very high. There's way more downside risk than there is in future upside appreciation. Way more. I mean, but I'm not saying you should sell yet, but you just have to be. It depends how risky you want to get. If all of a sudden you've made just a real ton in real estate or something because of a great investment where you bought low and you bought a lot of and you made huge profits. Yeah, I mean, why even risk it? What are you going to? You're going to hang in there maybe and risk it for another 5 or 10% upside when the downside's 4 or 5 or 6 times that much? No, you don't. That's not the way. That's not the way you get ahead in life. That's high risk. High risk, low return. So no, now's a very risky time to be buying.
In real estate booms and busts, is it the value of the land that increases and decreases? Yeah,
primarily. Sure. I mean, the value of the land goes up and down, and so that's part of the cycle. I mean, during the boom times, when you get up near the peak, land, typically performs way better than improved property by itself. Let's say housing prices go up 50%. Land could go up 60, 70%, maybe even more depending on where the land is. And then on the way down, it's just, it's the same proportion. Housing prices can go down, 40%, and land will go down 60 or 70. So that's why land is the best place to make money if you can nail the timing. So, I mean, it's way more volatile, but it has way more upside potential, especially if you're a builder and you're gonna put something on it where you're your own developer and you can, You're the developer, you're the general contractor, and you're the supervisor. So that's a 30% profit right there, where you can build something and add value to it. Then you can really make some money. You learn these things as you get older and look back and say, wow, look how that would have worked out, because you don't even think about it. Think about some of these things when you're young, because nobody teaches them to you. You're not going to learn it in college. I mean, I have a degree in econ from UCLA, and those guys they weren't then. We did learn some things, but nobody taught me about stuff like this.
What percentage of real estate investors make money?
I would say most. I would say probably, if you look over time, I really don't know. I would because it depends. Like if you look at a real estate investor, if you make a 30-year time horizon, I'd say it's very good, because real estate keeps going up, even the downturns. As long as you held on, you did fine. But if you put the time frame, in a shorter period of time, like 5 years, it could be it couldn't even be close to that high, because what happens, what determines the success or the failure of most people in real estate is whether they were in a bull or bear market. During bull markets, everybody makes money. During bear markets, everybody loses money. So it depends when you got in. That's what determines it. But they aren't giving away money in real estate, I'll tell you that. I mean, so it's one of those things. You've got to earn your money. You've got to know the cycles. You got to know the game. It's a magnificent game. But like in the real estate development, which was my business and my dad's business, that I've seen major developers, big guys, that were just like, rulers of the universe. And all of a sudden, they went broke because they started these projects with high leverage and got caught in a bad market and ended up losing everything. So, I mean, developers that have a super high failure rate, maybe 80%, end up going broke because it's a risky business. And that you're with borrowed money and you can get hung out there. But, these are the kind of things that I like to talk about now, because it gives you perspective on, the actual risk in the world, as opposed to these glowing success stories where that make you want to think there is no risk. Yeah, there is risk, guys. There's a lot of risk. If you screw up or get screwed up someplace, you can lose all your money very easy. So it all depends where we are in the cycle.
Are there profitable and safe ways to make money in real estate?
Well, there's always. I'll tell you the most profitable way to make money in real estate. And I'm acting as a builder developer now. Okay, I'm going to wait until the bottom of the cycle, and I'm pretty good at identifying either at or near the bottom of real estate cycles. I'm going to wait till that time. I'm going to buy a piece of land, vacant land, and I'm going to build a home on it, or a property. I'm going to build a home on it to live in. I'm going to build a home on it, and let's say the home costs me whatever it is. It's only costing me 70% because I'm doing 30% of the work myself. So I'm building a cool home at a good price at the bottom of the market. And then that $100,000 home, it cost me $100,000. It's probably not worth $100,000, or else I couldn't make a profit when I sold it. So it's probably worth, like, let's say $120,000. Okay, so good. So now I'm making $20,000 on the added value, and 30% from my own, $30,000. You can make $50,000, $50,000 just like that, added equity in an appreciating market, and that just ride the cycle up. You've created $50,000 worth of equity. That's what you've created for yourself at the bottom of the market. So the house wasn't $100,000. It was like your net cost in the house was like $50,000. That's where you want to start, at the bottom of a new cycle up. You can buy at the bottom. That's the way to make the most money, guys. Now, do you have to how about you have to know how to build a house? Yes, you have to know how to build a house. I think there's other things more challenging in this world than learning to build a house. I think that with enough bananas, you could teach a monkey how to build a house. So any variation in what you do right there, but that's something that it's very doable. And I mean, just from a pure money standpoint. Then if you moved in the house, moved in the house, you're going to do great. Owner-occupied house, and it's going to go shooting up in value. It should, like when the cycle turns. And now you got a great house. You're making a lot of money, and life is good if you take care of your health.
Is a significant amount of people's wealth in their home, and should this be concerning for a real estate downturn?
Well, sure. I mean, there is a lot of money. And I think nationally, something like the average individual's net worth, like 50% of it is the equity in their home. And we're talking at these inflated values. I mean, so just think of if real estate values drop 25%, where all of a sudden, now it's going to be like, it's not going to be 100%, it's going to be 50% because they just lost $50,000 worth of equity. So it depends what you need that equity for. And most people are not rich by any means, any stretch relative to what it costs to live today. Only 10% of the population that work, that are pretty safe, that are okay. Everybody else is some degree of month to month. So that is significant that when that turns down.
Do you have some words of wisdom for us?
What I would like to emphasize now is that all of a sudden I just came across this old idea again, and with respect to whatever you want to do in life, and let's use it for taking care of your health. I've had an annual gym membership for 30 years, so I know a thing or two about people that come and people that go. There's people that show up at the gym, and all of a sudden they just work their butt off, and they're all motivated and gassed up, and start lifting weights, and then look real good, and then don't show up at the gym, and you see them 2 months later, and they look. I mean, it's all gone. So I mean, they feel like crap because they put on a lot of weight. So as opposed to doing this, the quick startups and then forgetting about it, that consistency that if you want to take care of your health, it's all about consistency. You just got to keep showing. Never quit, guys. Ever. I go to the gym and lift weights 3 times a week, every 2 days. And that's what it takes to just keep your muscles strong. And it just makes you feel good. So all of a sudden you're strong. We're not talking about super strength, but you're not a wimp either, which is, what you don't want to be. And you know what it does? It makes you feel good. It's super healthy to do. It gives you confidence. When you're in shape, you look better. More chicks look at you. I can guarantee you that. So, I mean, it has all the health benefits are amazing, but it's consistency, guys. That's what separates that's what separates the guys that really do well versus just, do well once in a while. They show up. And my rule for consistency is this, that you can never miss 2 days in a row. 1 day is fine. Okay. You get a pass on that, but not 2 days. Then you got to go for sure, after that. So, and it's that kind of consistency. And I'm sure that applies to other things. If you want to learn something, you don't just always, it's going to take a long time to learn something. So you consistently have to, upgrade your thinking and do research and stuff like that. And pretty soon that, you've got something that you can keep. But you're not just going to pick up a book and have to all of a sudden learn about it in 2 or 3 hours. So, but that consistency, that's one of my mantras, guys. Just be consistent. Don't never, ever, ever stop. You can't stop. I've been doing this 30 years. You think I can stop? No. You think I'd want to stop? No. So, I mean, that's my words of wisdom.
Where can people subscribe to your letter and subscribe to that service?
They can go to realestatetiming.com. Realestatetiming.com. Just like it sounds. And it's, you can see what I do.
Bob, thank you so much for being on This Week in Money.
Oh, thank you very much.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, Mark Leibovit, and Robert Campbell. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.